So, you're trying to buy a house, are you? Bless your little cotton socks. You're scrimping, you're saving, maybe skipping that avocado toast or two, and you're dreaming of the day you finally escape the rental treadmill. Well, let me just casually inform you that while you were blissfully scrolling through perfectly staged kitchen photos 3 weeks ago, the Chancellor of the Exchequer stood up in Parliament and, with the quiet confidence of a surgeon removing the wrong kidney, casually arranged for your deposit to be instantly reduced by an extra £3,000. Just like that. Poof. £3,000 yanked straight out of your hard-earned savings. And the best part? Almost nobody knows this financial shiv is coming for them. They think they have a plan. They think they have a budget. They are, shall we say, utterly unprepared for the tax apocalypse currently unfolding. But here's the thing that should truly set your hair on fire: this wasn't just a hit on first-time buyers. No. This budget didn't just tweak the thermostat, it fundamentally burned down the blueprint for how middle-class Brits build, maintain, and pass on wealth through property. Whether you're a landlord, a downsizer, someone hoping to pass a pension to your kids, or just a hopeful first-timer, you either just got a one-way ticket to financial destruction or a secret golden opportunity. The rules of the property game just changed. And if you don't know the new rules, you're not going to lose, you're going to be eliminated. And since we're about to wade into the murky swamp of government financial policy that is designed to blindside the public, you're going to need a guide. If you want the unvarnished, brutal truth about where your money is going, and more importantly, how to keep it, go ahead and hit that subscribe button right now. Seriously. We track the chaos so you can stay solvent. Right, let's dive straight into the first change, and this is the one that's currently lighting the property market on fire. This is the stamp duty cliff edge, and it's a terrifying drop for thousands of buyers who are walking straight towards it, staring at their phones, completely oblivious. The key date you need tattooed onto your eyelids is April 1, 2025. And no, this is not a joke. Up until that date, the system has been offering a crucial lifeline to first-time buyers. Specifically, you paid absolutely zero stamp duty on properties valued up to £300,000. That zero was the margin that allowed countless people to finally scrape together enough for a deposit without having to worry about an additional 4 or 5 figures of tax on top. But mark my words, on April 1st, that crucial threshold disappears. It shrinks, overnight, to a far less helpful £175,000. Let's translate this bureaucratic nonsense into cold, hard cash, because this is where the pain becomes exquisitely real. Imagine you are eyeing a typical family home, nothing extravagant, maybe a basic 3-bedroom semi in the suburbs, priced at £250,000. Under the old rules, if you get the keys on March 31st, your stamp duty bill is zero. You pay nothing. You feel good. But if, for some conveyancing nightmare or bank delay, you complete your purchase on April 2nd, just 2 days later, you suddenly owe the Treasury a cool £2,500. That's $2,500 that simply wasn't in your budget the day before. For most first-time buyers, this isn't pocket change. This is the absolute edge of their financial capacity. They've already exhausted every possible avenue to get the deposit, borrowing the maximum from the bank, and operating on a budget tighter than a drum. Suddenly demanding an extra £2,500 doesn't just make buying harder, it makes it impossible. It forces a painful, crushing reappraisal of their entire life plan. But hold on, the pain train doesn't stop at first-time buyers. Everyone else, regular homeowners trying to move up, downsize, or relocate, is also getting walloped. Their tax-free threshold is dropping from £250,000 down to a paltry £125,000. Consider a £400,000 property transaction. Before April 1st, you'd pay £7,500 in stamp duty. After the deadline, you're staring at a £13,000 bill. That is an instantaneous £5,500 jump, vanishing from your moving funds for no reason other than poor timing. It's completely understandable why the market is currently experiencing absolute pandemonium. Everyone who is already in the pipeline is now desperately trying to cross the finish line before the tax gate slams shut. Solicitors are swamped, conveyancers are overwhelmed, and we're seeing two major, predictable outcomes. First, some deals are collapsing entirely because the buyers realize they simply cannot afford the suddenly inflated tax bill. Second, others are engaging in panic buying and risky corner cutting just to beat the clock. It's a logistical nightmare that's straining the entire transaction chain to its breaking point. And here is the critical aftermath that almost no one is correctly forecasting. Post-April 1st, first-time buyer demand is going to fall off a cliff. All those buyers who were stretching themselves to the limit, the ones who couldn't absorb that extra £2,000 or £3,000, will be forced to retreat. They'll exit the market for a year or more while they painstakingly save up the new, higher stamp duty component. The result? Massively reduced competition for sellers. This means vendors who need to sell, particularly those with starter homes, will struggle. And when demand softens, prices, especially in the entry-level brackets, are likely to follow suit. So, if you're a prepared, well-funded buyer who can comfortably handle the new stamp duty rates, and crucially, if you can afford to wait, the weeks and months following April 1st could actually present a sneaky buying opportunity. While everyone else is licking their wounds and complaining about the government, you could be picking up properties at a better price because the competition has evaporated. It's a ruthless strategy, but this is a ruthless market. But before you get too excited, let me show you the second change, because this one is arguably even more brutal for the supply side. If the stamp duty change was a tactical strike on the buyer's deposit, this second measure is a financial nuclear bomb detonating under anyone who owns an investment property. If you possess any real estate that is not your primary residence, a buy-to-let, that inherited house, or a quiet holiday cottage, the amount of tax you owe when you sell it has just been brutally increased, and unlike the stamp duty change, this one is effective immediately. The moment the Chancellor sat down, the rules changed. We're talking about capital gains tax, CGT, on residential property. Previously, the tax on your profit, your gain, was 18% for basic rate taxpayers and 28% for higher rate taxpayers. The new regime: a sharp, unfeeling increase, 24% for basic rate and a punishing 32% for higher rate taxpayers. That is a direct, across-the-board, 4 percentage point deduction from your investment returns. Let's move past percentages and talk about the real-world deduction this creates. Now, you might be cheering, thinking, great, more supply, house prices will fall. And that's partially true. However, the situation is far more nuanced. At the exact moment existing landlords are selling, new investors are looking at the 32% exit tax and thinking, the returns on property just got dramatically worse. Is this still worth the capital risk and regulatory burden? The answer, for many, is a resounding no. So you have supply increasing temporarily, but the replacement demand from long-term investors has dried up. This creates a looming disaster for renters. Fewer people are willing to be landlords, which means fewer rental properties overall, which inevitably drives up rents for the millions of people who rely on the private rented sector. The policy designed to be politically popular by taxing evil landlords will end up punishing the very tenants it was supposedly meant to help through higher monthly payments. And it bears repeating, this crushing 32% CGT rate applies to all non-primary property. That means your cherished holiday home, any inherited property you need to liquidate, and even that fix-upper you bought, renovated with your own sweat equity, and intended to sell for profit. All of it is subject to the government taking nearly 1/3 of your entire gain. Unlike income tax, where you enjoy the money as you earn it, here you take all the risk of the property dropping in value, and when it finally pays off, Now, let's talk about the change that is truly devastating, a slow-motion financial car crash that millions of families won't even see coming because it doesn't take effect until April 2027. This is the subtle, silent killer buried deep in the budget documents, the end of the sacred, tax-exempt status of private pensions. Historically, pensions were the gold standard for tax-efficient wealth transfer. You died, and your £500,000 pension pot passed directly to your children or beneficiaries, untouched by the cruel hand of inheritance tax, IHT. That was the deal. That was the incentive to save. The budget ripped up that deal. From April 2027, your pension pot will be included in your total estate for inheritance tax purposes. This means if your total wealth, your house, your savings, and now your private pension, exceeds the IHT threshold, currently around £500,000 if passing on a family home, that pension is now subject to a crippling 40% IHT tax before your loved ones see a single penny. Let's use the most common scenario to illustrate the sheer brutality. Picture a 65-year-old couple. They did everything right. They saved diligently. They have a house valued at £400,000, savings of £50,000, and a respectable pension pot of £400,000. Their total estate is £850,000. Under the old rules, the pension was outside the calculation, and IHT was minimal or zero. Under the new rules, every single one of those assets is now counted. Subtracting the typical £500,000 IHT nil rate band, that leaves £350,000 taxable. But here is where the financial violence escalates. If your children then withdraw that now taxed pension money, they may also have to pay income tax on it, at rates potentially ranging from 20% to 45%. Do you see the terrifying math here? You're looking at 40% inheritance tax on the way out, compounded by up to 45% income tax on the way in. The effective tax rate on some inherited pension wealth could soar to 70% or higher. Think about the message this sends: you acted responsibly. You didn't spend the money, you saved it for the next generation. You trusted the government's promise of tax-free inheritance for that pot. And now, the state is poised to claim up to 70% of that sacrifice. This isn't just shrewd taxation. For the middle class who can't afford offshore trusts and complex legal structures, this feels suspiciously like state-sanctioned confiscation. The truly wealthy will restructure their affairs by 2027. The poor won't be affected. It is their vast, responsible, wealth-building middle that will be absolutely decimated by this under-the-radar change. What makes these changes so impactful is that they don't operate in a vacuum, they collide to create devastating financial weather patterns. They are not merely isolated tweaks, they are synergistic disasters for certain groups, but conversely, they create unexpected openings for those quick enough to spot them. Let's look at the 4 perfect storms currently brewing. Storm 1, the first-time buyer squeeze. You are trying to save in an environment where CGT hikes have reduced rental supply, pushing your rent payments through the roof, making saving nearly impossible. Interest rates are still elevated, meaning your mortgage is more expensive. And now, stamp duty has added £2,000 to £3,000 to the already near impossible upfront cost. You are being financially waterboarded from every direction simultaneously. Higher rent kills savings capacity. Higher stamp duty demands more savings. Higher Storm 3, the small landlord annihilation. You are a small, mums and pops landlord with 1 or 2 properties. You are being hit by a hurricane of policy. Capital gains tax just went up. Section 24 mortgage interest relief restrictions already destroyed your cash flow years ago. New regulatory burdens are piling up from the Renters Reform Bill. Energy efficiency mandates require expensive upgrades. The returns have shrunk, the hassle has exploded, and the tax man is now your primary beneficiary. The only logical question for these individuals is, why am I still doing this? They are selling up in droves, and while institutional, professional landlords can absorb this, the exit of small players means a critical reduction in flexible rental supply, ultimately making life harder and more expensive for their tenants. Storm 4, the middle-class inheritance decimation. Your parents worked their whole lives for an estate worth, say, £750,000, a house and a decent pension. Nothing crazy, just comfortable. Under the old rules, inheritance was painful but manageable. Under the new rules, with the inclusion of the pension pot, the tax bill could balloon, carving an additional £100,000 or more directly out of the inheritance you were counting on. The truly wealthy use complex structures to avoid this, the poor don't have enough wealth to trigger it. The middle class, with their £500,000 to £2 million estates, the ones who diligently saved into the system, are the ones who get utterly crushed. But amidst this chaos, as always, are the 4 hidden opportunities for the well-informed. Opportunity 1, the post-April buyer's market. Once first-time buyer demand collapses after April 1st, competition for entry-level and mid-range properties will plummet. Sellers who are still in the market will face fewer offers and longer selling times. If you are a buyer who has the extra stamp duty money saved and can move decisively, you gain negotiating power. You might be able to secure a better price that entirely offsets the higher stamp duty you must pay. Be patient and strike when the market is depressed. Opportunity 2, the ex-rental property acquisition. Landlords are selling en masse, creating an influx of ex-rental properties. These homes are often chain-free, in decent condition, as they had to be rentable, and crucially, the landlord is often a highly motivated seller looking for a quick exit before the next tax hike. If you can identify these listings and approach the seller with a solid, fast offer, you might be able to secure a genuine bargain below the asking price. Opportunity 3, accelerated pension restructuring. The 2027 inheritance tax change on pensions gives those in their 50s and 60s a window of nearly 2 years to act. There are legitimate, complex strategies involving gifts, trusts, or simply a change in retirement spending philosophy, spending more now instead of preserving everything for inheritance, that can mitigate the 40% IHT charge. The window is closing. Immediate action and professional advice are necessary to potentially save hundreds of thousands of pounds. Now that you understand the rules of this new, brutal game, let's talk about the specific playbook. What do you need to do, based on your situation, right now? If you are a first-time buyer and you can realistically complete before April 1st, your mission is simple: move heaven and earth to exchange contracts before the deadline. Chase your conveyancer daily. Make sure they know the difference between March 31st and April 1st is thousands of pounds of your money. Remind them that it is the exchange date that legally matters for the stamp duty rate, not the completion date. Push them until it gets done, because that £2,500 is your immediate loss if you miss it. If you are a first-time buyer who will not complete before April 1st, do not panic buy the wrong house just to beat the deadline. It is far better to pay the extra £3,000 in stamp duty on the right house than to rush and commit to the wrong one forever. Accept the new cost, adjust your budget, and then play the waiting game. Be patient. The market is likely to soften after April 1st when demand wanes, and you might be able to negotiate a better price that offsets the majority of the tax hike. You are now positioned for opportunity 1. If you are a landlord contemplating selling, run the numbers, and run them again. The 32% CGT hit is painful, but you must factor in the risk of future, potentially higher, tax increases. Get professional tax advice to calculate your exact after-tax proceeds. Do not sell purely out of anger, sell because the total financial picture, factoring in reduced cash flow, regulatory hassle, and the risk of further tax assaults, genuinely no longer makes sense for your portfolio. Sometimes, holding a decent asset, even with tax, is better than selling prematurely. If you are a landlord contemplating buying, run conservative numbers. The old rules of buy-to-let are dead. You must factor in the higher purchase stamp duty for second properties, the 32% CGT exit tax, the Section 24 restrictions, and the new regulatory burden from the Renters Reform Bill. If the property still yields a healthy return after you account for all these costs, including void periods and maintenance, then proceed. If your maths relies on the old, relaxed assumptions, you will lose money. If you are nearing retirement with significant pension savings, 50s, 60s, this is non-negotiable. You must speak to a qualified financial advisor now. The April 2027 IHT change is not something you can DIY. Hundreds of thousands of pounds are at stake, and strategic action now, whether it involves utilizing trusts, gifting assets, or changing withdrawal plans, is essential. Do not wait for 2026. Your financial legacy depends on acting quickly and professionally to mitigate this time bomb. If you are expecting an inheritance, have the awkward, necessary conversation. Your parents or benefactors may still believe their Let's quickly synthesize the larger picture of what this budget achieved. It was not a technical exercise, it was a fundamental redistribution of financial pain. The winners. 1. The Treasury, obviously. They are collecting billions more in stamp duty, capital gains, and eventually, inheritance tax. 2. First-time buyers who exchanged before April 1st. You timed the market perfectly and locked in the lower rate. Congratulations! 3. Cash-rich buyers after April 1st. You can leverage the collapse in demand caused by the stamp duty hike to secure better prices. The losers. 1. First-time buyers completing after April 1st. You now have a higher barrier to entry. 2. Small landlords. You are facing the end of your financial model via higher CGT and regulatory pressure. 3. The middle class. You are the main target for the new IHT on pensions, paying a tax the ultra-wealthy avoid and the poor don't face. 4. Renters. You will ultimately pay the price for the landlord exodus through shrinking supply and higher rent. The rules of UK wealth transfer have been entirely rewritten, creating higher entry barriers, higher taxes on investment, and higher taxes on legacy transfer. This is the new reality. Your next move in the property market cannot be made on the old assumptions. Understand which category you fall into, know your deadline, and act decisively. If you found this breakdown of the chaos helpful and want to stay ahead of the next tax bombshell, make sure you hit subscribe. We will keep tracking the aftermath, the prices, the opportunities, and the tax pitfalls, so you can navigate this new, treacherous financial landscape.